I think there were two things. One was the increased market volatility, and they got a little bit worried about, well, what is the market telling us? And given all the tumult that was there, and could the tumult itself be self-fulfilling, that people start to lose confidence, and so that could lead to lower consumption, could lead to lower investment. And then I think the other piece was just some of the data were starting to come in a little bit more mixed. We had a pretty strong growth period last year, and 2018. As the rest of the world was slowing, the U.S. was accelerating. That's a real outlier. Almost everybody else was slowing last year, and in some cases slowing quite significantly. We're not going to be able to maintain that this year, but I think there was a concern that we could see a little bit more slowing this year, concern that some of the market tumult could turn into a real headwind, and I think that's why they pivoted.
And what do you think could make him change tact once again to go back in the other direction, given, of course, that markets have bounced back, albeit the international outlook for the macroeconomy has not, of course, improved?
I think the real issue is going to be inflation pressure, and that was one of the reasons why during the testimony he focused so much on the labor market, focused so much on the ability of the labor force to be able to grow, that more people are coming back in, and so that means that we could be running at a very low unemployment rate of around 4% or even less without seeing too much inflation pressure. And that's really going to be the key thing that they'll be focusing on. Where is the inflation pressure and where are inflation expectations, both of which are quite muted right now, so it makes it easy for them to say, let's be patient. But if that starts to tick up, that could change things.
Randy, just to dig into that a little bit more, this idea of reassessing or even changing the framework for how the Fed assesses inflation, is that something that should happen?
So I think it's important to have a broader rethink, because clearly the traditional way of thinking about inflation dynamics is not really having a lot of traction right now. We have an extraordinarily low unemployment rate, and we've seen very low inflation pressure and relatively low wage pressure. So rethinking those fundamentals are, really what's driving inflation, and then also rethinking about how the Fed talks about inflation, because inflation expectations are probably one of the most important factors for determining how price changes, how wage changes are actually going to occur. And one of the things they're talking about is saying, well, rather than just this simple inflation goal of 2%, maybe we should have a little more flexibility about that. That if we've been undershooting it for a while, maybe we should have more flexibility to overshoot it for a while. That's controversial, but I think it's legitimate to be having that discussion.
Would that mean that rate cuts, if we did see a bit of an economic downturn, could be more likely than otherwise if they're willing to allow inflation to spike up a little bit?
Exactly. And so they're willing to allow the economy to either, quote, run a little bit hotter, have a little bit more inflation, and so they'd be more reluctant to be raising rates, or they might be reducing rates more rapidly. And they would want to convey that that's what they're trying to do, because they don't want to get into a Japan-like situation. They haven't mentioned Japan, but I think that's sort of the example that's in the background, that if you undershoot your inflation goal for a long time, you might lose credibility in saying that you really do want 2% inflation. And in Japan, inflation expectations basically went down to zero or even became negative. And it's been extraordinarily hard for the Bank of Japan to revive inflation expectations.